Thank you for joining me this Friday, the 3rd of February. I'm Grady for Market Analyst with Bell Direct, and this is the weekly market update. With the RBA coming out this week saying it believes inflation in Australia has peaked, investors have been weighing up recent economic data against a possible easing of rate hikes down under, ahead of the RBA's first interest rate meeting for 2023 on Tuesday. So what can we expect from the RBA next week, and where is inflation hitting the hardest in the current environment? Australia's inflation rose 1.9% to hit 7.8% for the December quarter, which is the highest level since 1990, driven by domestic holiday travel and accommodation lifting 13.3%, electricity jumping 8.6%, and international holiday travel and accommodation rising 7.6%. While inflation remains high in Australia, it is projected to decline gradually, but remain above the target range of 2 to 3% until 2024, according to the International Monetary Fund. When inflation first started rising in Australia, it was predominantly on imported goods like petrol, building materials and fresh food. But in the December quarter, services inflation was higher than product inflation, which indicates inflation is becoming stickier in the domestic economy, rather than just on imported products and services. A clear example of this is through domestic holidays contributing the most amount of price inflation during the December quarter. With services inflation growing more rapidly, this supports the notion that inflation is not set to reach the RBA's target range until at least 2024, as services prices are less volatile and tend to take longer to rise and fall. Declining retail sales is another indicator that the RBA's interest rate hikes to date are starting to take effect, with a decline of 3.9% in December, which is traditionally a month of high retail turnover. So what does the current inflation rate and RBA rate hike stance mean for markets? Sectors that traditionally perform well in a higher interest rate, high inflation environment include consumer staple stocks and gold. Year to date, the consumer staples sector is up 6.65% and is up 7.5% over the last year, as investors see price rises on staple goods will be passed on to consumers without impacting demand, which therefore provides a financial buffer to take on higher costs for such companies. Woolworths and Coles shares are both up over 9% each since the start of January, as price freezes on trolley items came to an end and higher prices of goods are factored into performance without denting demand for goods sold. Gold stocks are also poised to rise during this high inflation, high interest rate environment, given the way that gold is traditionally hedged against inflation, as its value tends to rise with the price of goods. The Aussie dollar spot price for gold remained resilient during 2022, despite the strong US dollar. So, with the recent downturn in the US dollar, the outlook for gold in AUD terms is positive for the year ahead. In 2023, consumer spending is expected to slow, but remember, while the cost of living pressures remain high, there are still some key sectors of the market that benefit from this high inflation, high interest rate environment. Locally, from Monday to Thursday, the ASX added 0.24% amid investors awaiting the highly anticipated rate decision out of the Federal Reserve on Thursday, which came in as expected at a 25 basis point increase. Information technology stocks had a big boost this week, coattailing on the tech-heavy Nasdaq in the US, as investors around the world regain appetite for growth stocks as central banks discuss easing interest rate hikes. The winning stocks from Monday to Thursday were led by Flight Centre, rallying 12% after announcing an acquisition and successfully completing a $180 million placement to fund it, while WiseTech Global and Xero each added 10.33% and 9.7% respectively. On the losing end of the market, Megaport took the biggest hit, declining 16.55% after releasing a quarterly trading update, including lower customer receipts, while Pinnacle Investment Management and Silver Lake Resources fell 11.7% and 8.4% respectively. Taking a look at the All Ords, MoneyMe soared 33% this week after reaching the profitability milestone and recording record revenue for the first half of FY23. Satire added almost 15% this week, and Redbubble rallied 14% from Monday to Thursday. New Energy Solar at the other end of the market performed well. It tanked 65% despite no price-sensitive news out of the company this week. The most traded stocks by Bell Direct clients this week were Xero, Seek, CSL, GrainCorp, IDP Education, Treasury Wine Estates, Suncorp, Pinnacle Investment Management, and AUB Group. Investors also bought into Winsome Resources this week. And the most traded ETFs by Bell Direct clients this week were Vanguard Australian Shares Index ETF, Vanguard Diversified Balanced Index ETF, and BetaShares Australian Strong Bear Hedge Fund. On the economic data front next week, all eyes will be on the RBA's rate hike decision out on Tuesday, with economists expecting a rise of 20 basis points, down from the 25 basis point rate hike in December. Australia's trade balance is also out on Tuesday, with the market expecting a decline in trade surplus to $8.5 billion from $13.201 billion in November. Overseas, UK GDP for December is out on Friday, with the market expecting a decline of 0.1% following a rise of 0.1% in November. And that's all we have time for today. I'm Grady Wolf with Bell Direct. We hope you have a wonderful weekend, and we will see you on Monday for our morning bell. Happy investing.